Welcome back, traders. So let's get started. Setting an optimized entry in trading is crucial because it directly impacts your risk-to-reward ratio and the overall success of your trades. An optimized entry increases the potential profit you can make if the trade goes in your favor. It helps you place your stop-loss orders closer to your entry point, reducing potential losses if the trade goes against you. By fine-tuning your entry, you can control your position size more effectively and manage your overall risk exposure. An optimized entry increases the probability of the trade moving in your favor, improving your win rate over time. It encourages disciplined trading by following a well-defined plan, which is essential for long-term success. Imagine we have a perfect sell setup here that meets the criteria and rules of a high-probability setup. These are the criteria we always look for in the market to identify such a setup. Firstly, you can see that the price is in a strong downtrend and has already reversed from a strong supply zone on a higher time frame. The next criterion is that the price must fill the fair value gaps. Yes, the price has done that. It swept the internal liquidity by filling the fair value gaps created during the downward movement, and now it's ready to move toward external liquidity. The next rule is that the buy-side or sell-side liquidity must be swept. And yes, we can see it on the chart. Price swept the liquidity above the previous structure here and immediately pushed back down, closing below the highs range. This allows us to identify a liquidity sweep pattern and a newly formed supply zone. This presents a good opportunity to go short if we decide to place an entry. The key idea behind this rule is that when buy-side liquidity is cleared out through a liquidity sweep, the price is then attracted to the sell-side liquidity, which is in line with its prevailing direction. Our fourth rule is that the price must be situated in the premium zone to consider placing a short position, or it must be in the discount zone to consider a long position. It's pretty clear that here, the price is above the 50% of Fibonacci retracement. The last rule is the presence of a higher time frame liquidity zone in front of the price that can be utilized as a potential take-profit level. When all these rules and criteria align, we have a high probability trading setup. However, the biggest challenge traders face after identifying this perfect setup is knowing how and where to enter the trade. This is the most critical and tricky part of trading. If you can't set up an entry optimally, you might still experience losses, even if you've identified a flawless trading setup and predicted the price's future direction. There are three main entry setups. The first one is the aggressive entry model, which carries more risk. The second is the conservative entry model, which offers entries with additional confirmation. And the third is the ultra-conservative model, which provides a setup with multiple confirmations across various time frames. Now let's get started with the aggressive entry model. Executing a trade using this entry model is like to placing a limit order within the higher time frame's demand or supply zone. Imagine we have a perfect sell setup, like the example on the chart, confirmed by the criteria and rules of a high probability trading setup. For placing a short position using this entry model, your entry point should be right at the lowest point of the supply zone. To manage risk effectively, set your stop loss a few pips above the highest point of the zone. When it comes to take profit, you can target the closest external liquidity at the same time frame, as we anticipate that price will move in that direction. Alternatively, you can aim for the higher time frame's major liquidity zone to achieve a higher reward-to-risk ratio. Risky entries come with their advantages. You're less likely to miss trading opportunities, and you don't have to constantly monitor the charts. However, there are drawbacks to consider. It provides higher risk because you've entered into the market without a reversal confirmation, and also you are not watching the price reaction when it reaches the area of interest. For instance, consider a situation where it coincides with the London-New York crossover, and a news event caused volatile price movement. There's a high chance the price hits your stop loss, and then starts moving down. Since this entry method involves a larger stop loss area, it obviously provides a lower reward-to-risk ratio. Now let's move into the conservative entry model details. In this entry model, we employ two different time frames for our trading approach. A higher time frame for market analysis, and a lower time frame for entry confirmation and order execution. I personally prefer using the 15-minute time frame for market analysis and then switching to the 1-minute time frame for executing my trades. However, you have the flexibility to choose other time frame combinations, like the 1 hour and 5-minute or the 4 hour and 15-minute, depending on your preference. The key principle to remember is that your market analysis time frame should be at least twice as long as your entry time frame.
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
To apply the conservative entry, we should wait for price to tap into the point of interest zone and show a rejection. Then our next step is to switch to a lower time frame. Closely monitor the price movement and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the lowest point of the newly recognized order block, in this case, a supply zone on the lower time frame, which is created by the change of characters wave. With a stop loss set a few pips above the highest point of the zone. And for the take profit, we set it at the external liquidity of the higher time frame. The pros of this entry setup are that it ensures a reaction at the point of interest by closely monitoring lower time frame price action, resulting in a higher reward to risk ratio due to the use of a tighter stop loss on the lower time frame. However, there are cons to consider. If the price decides to flip the identified point of interest and continues its upward movement, your stop loss placed on the lower time frame may get hit. Because by using this type of entry, there's also the possibility of a continuation flip pattern forming on the higher time frame. Or if the price requires more buy-side liquidity to be swept, using this type of entry may trap you in the market. Another drawback is that you're more likely to miss out on trades if you refine your entry zone too much. Now let's dive into the third entry setup, the ultra-conservative entry. Imagine we have a perfect sell setup on a higher time frame like the 4-hour time frame, which is confirmed by the criteria and rules of a high probability trading setup. Our next step is to switch to a lower time frame like the 1-hour time frame. Closely monitor the price movement and patiently wait for the price to return to the higher time frame supply zone and demonstrate a change of character pattern. After detecting the confirmation for market structure shift on the 1-hour time frame, to apply the ultra-conservative entry setup, we need to follow a few steps. First, we should identify and highlight the supply zone generated by the change of characters bearish wave. Then we need to zoom into a lower time frame like the 15-minute time frame and patiently wait for the price to tap into the identified 1-hour time frame supply zone to get reversed from it and create a change of character on the 15-minute time frame. Our next course of action is to identify the order block generated by Chalk's wave in the 15-minute time frame. In the next step, we should zoom into the 1-minute time frame and wait for the price to enter into the 15-minute time frame supply zone to get reversed from it and show a change of character pattern. Once the change of character is confirmed in the 1-minute time frame, we can proceed to identify the order block attributed to the change of the character's wave. Subsequently, we place a sell limit order at the lowest point of the zone, with a stop loss set a few pips above the highest point of the zone. As for the take profit, we have the option to target the unmitigated demand zone on the higher time frame like 15 minutes or 1 hour, or the swing low of the current time frame. These steps will help us execute an ultra-conservative entry with a well-defined risk-reward ratio. The ultra-conservative entry model has its advantages. It utilizes multiple time frame reversal patterns for trade confirmation, significantly boosting the likelihood of successful trades. Moreover, it offers a more favorable reward-to-risk ratio by meticulously refining entry points on lower time frames. However, there are notable cons to consider. First, this approach demands more time for monitoring price movements across various time frames. Additionally, seeking extensive confirmation before executing trades might lead to missed opportunities, even if prices move in the anticipated direction. Another downside is the potential to miss many trades when overly refining the entry criteria. Now that we have fully covered all the entry setup options available for placing buy or sell positions in the market and have acquired a solid understanding of them, imagine we've identified a high probability trading setup on the chart that aligns perfectly with the criteria and rules of a high probability setup. What we're doing next is searching for an entry point and, most importantly, getting involved in the market. Before executing any trade, it's crucial to consider a key factor: invalidation. We need to be mindful of the elements and conditions that could invalidate our trading setups, potentially resulting in a losing trade. This applies to all our trading setups, even those that appear perfect and highly probable. If we identify any factors leading to invalidation, if we identify any signs of invalidation, it's a clear signal not to enter the market. So what factors can cause the invalidation of a trade? The first and perhaps most critical factor to consider is the time of day. Imagine you've identified a flawless and perfect trading setup, one that aligns perfectly with your trading plan, offering an exceptionally high probability of success. The price is on the brink of reaching your highlighted point of interest, and you've set an appropriately small stop loss, creating an ideal trade opportunity. However, there's a catch. The market lacks the required momentum and liquidity. This might happen during the Asian session or in the late hours, like around 12 p.m. or 5 a.m. In such cases, the likelihood of this trade becoming a winner is rather low. To trade successfully at the right times, you need to know how the market acts during different parts of the day. Each part has its own behaviors, like how things move in Asia, or when London has reversals or fake-outs. Also, it's important to understand when these trading times overlap, such as when New York and London are both active, and what usually happens during those times. This knowledge helps you make smarter trading choices and boosts your chances of winning trades. Before we delve into the next factor that can invalidate a trade, let's take a moment to explore these trading sessions and their behaviors. The Forex market operates 24 hours a day, 5 days a week, and is divided into different trading sessions based on major financial centers around the world. Each trading session has unique characteristics, and price behavior can vary during these sessions. There are 4 main trading sessions. The first is the Sydney session, which runs from 10 p.m. to 7 a.m. in the GMT time zone. This session mainly involves 3 currency pairs: the Australian dollar, New Zealand dollar, and Japanese yen. Next is the Tokyo session, which also runs from 10 p.m. to 7 a.m. in the GMT time zone. The primary currency involved in this session is the Japanese yen. Additionally, there is some overlap with the Australian dollar and New Zealand dollar pairs. Tokyo session is known for its stability and liquidity, especially in JPY pairs. Volatility can increase during economic data releases from Japan. The third major session is the London session, which runs from 8 a.m. to 5 p.m. in the GMT time zone. London is the financial hub of the world, and this session sees the highest trading volume and liquidity. It often sets the direction for the day. Price swings and trends are more pronounced. But before moving to the next, it's important to note a crucial step in your trading journey: backtesting your strategies. Before using a strategy or setting up a real account, it's recommended to backtest it at least 100 times. Backtesting helps traders gain insights and enhance their trading strategies. The fourth major session is the New York session, which operates from 1 p.m. to 10 p.m. in the GMT time zone. The New York session also has significant liquidity and is known for high volatility, especially during the overlap with the London session. Economic data releases from the US can lead to significant price movements. Also, we have overlapping sessions. There are times during the trading day when multiple sessions overlap, such as the London-New York overlap, which occurs from 13 o'clock to 17 o'clock GMT. These overlaps often see the highest trading activity and are characterized by increased volatility. Now, let's have a quick breakdown of prices' behavior during major sessions. Asian sessions. Typically, prices may consolidate or trade within a narrower range during the Asian sessions as liquidity is lower. Breakout moves often occur when the London session begins. London session. This is when the market tends to see the most significant price movements and trend formations. Many traders prefer to trade during this session due to its high liquidity and volatility. New York session. Similar to the London session, the New York session can also see substantial price swings, especially during economic data releases and news events related to the US economy. It's important to note that while these sessions have their typical price behaviors, unexpected events and news can lead to sudden and significant price movements at any time. Traders should be aware of these sessions and their characteristics when planning their trading strategies and risk management. Now let's delve deeper into the details of invalidation. As previously mentioned, the first factor that can lead to invalidation is the timing of our trade execution. If a setup occurs outside of the optimal trading hours, we will choose to refrain from trading. For the London session, the most optimal time for trading is generally during the first few hours. This period often sees the highest liquidity and the most significant price movements. Many traders prefer to start trading when the London session opens at 8 o'clock GMT, because this is when markets tend to set the initial direction for the day. Major economic data releases related to the European economy are often scheduled during this session, which can lead to increased volatility. The most optimal time for trading during the New York session is typically during the overlap with the London session. This overlap often experiences the highest trading activity and liquidity. The first few hours of the New York session can also be favorable for trading, as this is when U.S. economic data is released and can result in significant price movements. It's important to note that after 17 o'clock GMT, liquidity can start to decline as the New York session winds down. Personally, I prefer to not trade after 5 p.m. because, particularly after that, most likely price will consolidate around major zone that has been formed through the day until London session starts at tomorrow. And for the Tokyo session, the most optimal trading time during this session is generally during the overlap with the London session, as both sessions see higher liquidity and potential for price trends. The next factor to consider is news and economic events. Forex markets often experience increased volatility and price fluctuations around the time of major economic releases. Economic news and events are critical drivers of price movements in the Forex market. Traders need to stay informed, develop strategies that suit their risk tolerance, and exercise caution when trading around news releases. If there is a very high-impact news or economic event either already released or scheduled to be released around the time your point of interest is being approached, it becomes risky to enter the market. This is due to the significant increase in liquidity and volatility such an event can create. Let's see some important economic news releases that can significantly impact the Forex market. First, we have the non-farm payrolls, NFP, published by the U.S. Bureau of Labor Statistics on the first Friday of each month. Measures changes in the number of employed people in the U.S. The second one is interest rate decisions, announcements by central banks regarding changes in benchmark interest rates. Changes in interest rates can influence currency values as they affect capital flows and borrowing costs. Number 3 is gross domestic product, GDP, measures the total economic output of a country. GDP releases can indicate a country's economic health and influence its currency value. And the next economic event is the Consumer Price Index, CPI. Measures changes in the prices of a basket of goods and services. What I highly recommend during a news event is to wait patiently for the excitement and volatility created by the event to settle down. Then, assess the situation and look for potential entry points. Avoid using pending orders like sell or buy limit orders during a news event. The third factor that can lead to invalidation is a sudden and rapid push into a point of interest. Price behavior is crucial, especially when it approaches our identified point of interest. Imagine the price suddenly gains strong buying momentum and moves directly into your identified bearish point of interest, from which you plan to enter a short trade. In such a situation, you should reconsider that zone as your point of interest and avoid executing trades from there. The rapid and massive move toward that area could keep pushing the price upward as it sweeps up buy-side liquidity, increasing its speed and volatility. This increases the likelihood that the price will use your identified point of interest as another source of liquidity. The next and last factor that can lead to invalidation is the fundamental. Traders should consider fundamentals alongside technical analysis in their training, because fundamentals provide essential context for understanding market forces, identifying long-term trends, and managing risk. Ignoring fundamentals and relying solely on technical analysis can lead to missed long-term opportunities, increased vulnerability to news events, inefficient trading, and difficulties in adapting to changing market conditions, potentially resulting in significant losses. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.